Welcome, everybody, to the Chinchilla Pickin' Podcast. It is December the 7th, 2022, 6:52 p.m. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and as always, I'm here with Brandon Beaver. Brandon, what is the significance of today, December 7th? Come on now, you're a history buff.
Pearl Harbor.
Pearl Harbor Day, that's right.
A day that will live in infamy.
Yep. See? Yeah. Well, boom. We're already on it. All right. Well, I just want to say thank you to any veterans and anybody, a family of veterans that are listening. Take this moment to remember Pearl Harbor, what it meant to us, and how resolute some people can be in attacking others. Just leave it at that. Moving forward today, though, I tell you what, Brandon, I'm going to be honest here. November was not a fun month for me trading wise. And December is just picking right up where November was for me. Now, I had a great first half of the year. We called everything. It seemed like we couldn't lose there for January was rough for me. I remember January being rough, but then I started getting in a groove and we just couldn't call anything wrong for a while. We're on a hot streak. And then now all of a sudden I'm in a rough spot again and I got to get my way out, but I am positive on the year. I am up on the year by quite a bit. So I'm very happy with my yearly return so far. But Tesla's back down again for me. Right after on Friday, I got on here and was like, hey, I might sell it. I'm about breaking even here. I'm gonna hold it, see what happens. Big mistake. I should have just sold because it just dropped on me. And now I have a chance to dollar cost average again. Let's get that.
So you're looking at this as a trade. And I know Tesla is not something that I should normally give advice on, given my track record with it. But right? I'm going to give some advice here. California, who knows if they're going to do the 2035 thing or not. Eventually, that's probably going to be a law once they're able to do it, that all California vehicles are going to be electric. Eventually, the United States is going to be mostly electric altogether. Buy Tesla and stop looking at it. Hold it for 20 years. I shouldn't say stop looking at it. Watch the quarterly reports and stuff like that. Check in with it quarterly and just don't touch it. Who cares if it's up or down? It's got a high beta. It's got high volatility. It's going to move 20, 30, 50%, whatever. Just leave it.
And I would agree with you, except that I entered into it thinking it would be a trade. Yeah. And that was the problem with me doing it this time. Do I want to just call it a long-term investment and just let it go? Maybe, but I entered into it thinking it would be a trade, and I'm kind of feeling stuck, if you will, in that trade there. But it is what it is, right? It is what it is.
It is what it is. It's one of those. Right, so I just think that like with Tesla, I mean, at times it looks really overvalued, but sometimes you just have to sometimes it's the what you buy and not the when you buy it, right? Like if it's an investment, sometimes the what matters more.
Gotcha. Yep. And I we're going to talk about two companies that are overvalued by a lot later on here in this podcast, guys. But let's go over the rules. Rules. Brandon and I get together 5 to 10 minutes before the show, and we tell each other what we're going to talk about. We do not actually discuss it. You hear the live discussion back and forth here on the show. Brandon, I'm gonna lead us off here because I teased this last time, saying I would look into this and see what happened with this company, what went wrong, why was this company just going down and down and down. So after looking into it, it was a very simple answers. There was a couple of different answers, and it was very simple, very basic answers. And I just did not do enough research at the beginning when we were talking about it over the summertime, saying, hey, this solid company seems to be doing well. I should have done more research at that time. So let me talk about CrowdStrike, right? So if you don't know, CrowdStrike is a cybersecurity firm. How they make money, they sell their service. They have subscription services and other services, but the subscription services is what really drives the revenue of this company. So then they call it the ARR, the annual recurring revenue, is how they report it in their earnings report. So the ARR is a big number, right? How many net new subscriptions? So this is now sounding like it's a Netflix thing, right? They're talking about subscriptions, and that's a big number in the earnings report. Yeah, so CrowdStrike's subscriptions, yes, they added 1,460 new subscriptions in their last earnings report. However, the same time last year, they added 1,600 new subscriptions. So it's a little bit down. They did beat on top and bottom line numbers when it came to their last quarter's earnings reports. So you ask, okay, if they beat top and bottom line, why did the stock drop 18% based off the last earnings reports? Well, when you dig just a little bit deeper, you don't need to dig that far. What they're coming out and saying is because year over year, the net new subscriptions are down. They're seeing that the larger companies are no longer buying, say, a year subscription or a 3-year subscription. The larger companies are buying a 6-month subscription or a 3-month subscription. So they're losing those longer deals. And CrowdStrike is fearing that this is part of overall recession to the economy. This is their term. This is their terminology in their earnings report, not mine. An overall downturn in the economy, and thus companies are going to spend less on cybersecurity. And that's why they're doing shorter subscription services and not signing up for the year or 2-year long. And that's why they're getting fewer net newer subscription services. Now, let's go real quick. I know you want. No, go ahead and talk. Why I look at this other stat.
No, I think that what that is that's companies trying to save money on their quarterly reports. They're gonna sign back up for it. I think it's companies trying to save money on quarterly reports. So, instead of paying for it all up front for 1 year, they'll pay a little less for 6 months. But I think they're going to sign back up. There is absolutely no good reason, even in a recession, for any company to cut cybersecurity in this environment while we're digitizing, while we're all going online, and while everybody that's in business has to survive on the internet.
So I would agree with you, but let me go into more of this ARR here, right? I like your point. Your point is good. You do have to, and this could be people just trying to shore up their own books for stockholders so that they can keep their share price higher. Now, their overall recurring revenue, the annual recurring revenue, the subscriptions was $2.34 billion. That's up 54% year over year. That should be good, right? That should be excellent. The problem is that when a CEO of a company that has yet to be profitable, because they are a newer company, they have yet to be profitable since coming out and listing, says that, hey, we got some headwinds coming up. I know we haven't broken a profit yet, but it's gonna be a little loose, a little heavier at that time before this last quarter quarterly earnings report. The PE ratio adjusted for GAAP was 74. So wow. They were expecting large growth to continue, and that's why it was such a high ratio. They were expecting the growth, and so that's 74 is what you give a brand new startup that is just growing at like 80% a year. That's when you buy in at 74 PE ratio. Now, and that's what CrowdStrike was. They're up 54% year over year, right?
Yeah.
But is 54% year over year, does that actually equal a 74 ratio, PE ratio? And everybody was saying it's overvalued. It needs to come down a little bit more and adjust for where it's at now and adjust for a 50% growth and not a 80, 90% growth anymore. And that's why the stock, I believe, has come down, is because of those numbers.
And that makes sense. And it still seems to be a little bit overvalued for today's market. But yeah, I mean, they had they more than doubled their earnings year over year. So that's great. But at a certain point, people were paying for companies and looking 4 or 5 years out, and they were paying that price today. But now that's not the case anymore. When the bear markets hit, then everybody starts to shore in and become a little less risk tolerant. And you see the non-profitable companies, especially, any company that may have to raise revenue in the future with higher interest rates, those values are going to come down, and CrowdStrike's come down with it.
And well, you also got to look at like companies like Walmart. Now I reported on this earlier in the year, spring, or actually it was winter, it was February. I reported on the fact that Walmart just created a whole cybersecurity division. They hired 10,000 people and just created a whole division just for that.
But CrowdStrike's really good at network cybersecurity and really good at using AI to predict within a nanosecond what hackers are trying to do and what they're gonna do, and blocking it from happening. So it's a premium cybersecurity company. So at a point you have to think like, okay, paying a premium for this not that bad, especially when EPS growth is relatively high. I think eventually they grow into their earnings at this point.
Well, see, and that's what everybody else was thinking, and that's why people were still buying when the PE ratio was 74, which has come down because the stock price has come down. But at what point does that ratio start to equal out? Okay, this is a good time to get in because now it's worth where it's going to grow into.
Yeah, I would look more. Let's see, where's it at right now? 113.19. It's down 43.5% for the year. Not as bad as some of its other, colleagues, and it's in the tech industry. If it went under 100, I would start to think about buying it personally.
Gotcha. So under 100
I'm not rushing out to buy
where
it
you would think it.
Yeah, and I'm not rushing out to buy it personally. I think there's other guaranteed plays, and I have them, like Google, for example, in the tech industry, specifically. But
people used to think Amazon was a guaranteed play, but I mean, look at its stock price the past 6 months.
I still think it is. If you've got a 20-year time horizon, who cares?
Yeah, I mean, if you have a 20-year time horizon, then yes.
Yeah.
Yes. But a lot of people nowadays, with the way that people are trained of, the short term attention span, people like to day trade in and out, which is what I do, but I also balance that out with my long-term investments. But everybody's looking for that quick buck right now, and nobody wants to sit on a 10 year.
Yeah, and that's true, but not everybody's like you as far as being good at that. Most people make bad trades in the long run.
Right.
And that's where the long-term investors come in and take advantage of that, So
Yep.
when you start to buy it at a good price because everybody's oversold it on a swing trade or a day trade or whatever, I would kill to be 18 right now, 18, 19. I love the fact that you're raising your daughter to invest, because I mean, just think about it. Like, if you're 18 years old, you've got like a 50-year time horizon in the market until you're in your 60s. Man, there are gonna be multiple multi-million-dollar opportunities that come into your hands when you're 18.
Yeah, if you're just putting away like a quarter of your money. I'll tell you what, that reminds me, this is why it's good to teach your kids, guys, how to invest. So I've taught my daughter how to invest. I've talked about it on here. I have the trust fund for her and all that, and she does her own investing. She recently had a car issue. Something broke on her car that she has. Mm-hmm. And she just pulled money from her stock account and fixed her own car herself at 17 years old. I don't know any other 17-year-old that can pull out like $600-700 to go fix their own car.
No.
And do it themselves and handle it all themselves. I don't know any. I've never met one.
All my money went to really stupid things when I was
right. I'm with you, yeah. And so very proud of her for that. But like, that's why you teach your kids these things, and to grow and invest, like you said. But people don't want to hear us talk about this. People want to hear us talk about the markets and where we're at now. So CrowdStrike, you're saying you wait for it to go down a little bit more. I'm just explaining what happened, why there are headwinds, and why this has gone down recently, and trying to give people some light as to why I thought it was a good solid play back then, but it was overvalued. So,
and it still could turn out to be, like, if you bought it back then and you hold it for a while, you might make your money back and then some. I still think it's a good company. And maybe you could even buy it now, but it just depends on what your time frame is. If
right?
it's in the next 6 months, probably not.
All right, so let's transition into another company that I know is your favorite company of all time, and you've been a fan of. Everybody's bought it, and you have never made fun of them on Stock Twits at all. We're going to talk about GameStop. Brandon has trolled the apes on GameStop on Stock Twits many, many times, and so I do want to talk about GameStop because they came out with some earnings today. Do you have anything to say before I get into the numbers, Brandon?
I'd rather buy Zimbabwe dollars.
They might be worth more. Who knows? So I'm coughing now. That's making me laugh too hard. GameStop reported a third quarter revenue of 1.186 billion, which was down from 1.29 billion the prior year's quarter. What a surprise! Revenue came down. However, GameStop reported a third quarter net loss of 31 cents per share, which missed the analyst estimates of 28 cents per share. So why is that a big deal? You're asking, like, oh, they had a loss, 31 cents. Well, it's a big deal because GameStop's earnings have continually gotten worse and worse and worse and worse over time. This is the first time in a while that they have improved their earnings. So they improved it in quarter two, and then now they've improved it in quarter three. That's 2 quarters in a row. They have improved their earnings. They stopped the bleeding, and now they're starting to turn it back. It's still not near profitable. They still were eating through $600 million of cash that they had saved up from selling stock shares, and they just burned right through that. And they are not. I don't know, man. I don't see a way for this company to continue. I think they're holding on with all life, hoping that the stock goes up to $400 a share again.
Yeah, there's going to be a handful of retail companies that go bankrupt if we do have a deeper recession. GameStop will be one of them. Belk might be another, just off the top of my head. Bed Bath and Beyond for sure is right on the top of that list. There's no good reason to buy a GameStop.
Yeah, there's no good reason to trade it or buy it. It's too volatile to trade it. You can't guess it. You're going to lose your money.
Yeah.
I mean, I would just stay away from it. But I just wanted to mention, because we've dogged them, but we've dogged them for good reason on the show, that their earnings kept getting worse and worse and worse and worse, and people kept buying it. And I will admit they have 2 quarters now of improvement in their earnings. Still negative, still lost, but improvement nonetheless. So there you go.
They do sell an NFT or something.
I I don't know. I don't know. That's a good question there. But yeah, it's improvement, Brandon. You got to give improvement where it happens, and you got to give credit where it's due. You know what I mean?
Yeah.
All right, Brandon, you got next topic, man. Go ahead. That's my 2 starters, my lead off.
As bad as you did last quarter. Good job. You're a little less terrible. All right, Dave. You know as well as I do, when I say this, I'm telling the truth. I really don't care for analyst predictions. I care for the reasons a lot, but like opinions are a dime a dozen. I stumbled upon this book the other day, and don't go try and buy it, because if you try to buy the book, it's out of print. But it's a Wall Street favorite, and you can tell it's a Wall Street favorite because if you go try to buy a book like new, and by that I mean like in new condition, this book is 100-1 in the stock market. It's by Thomas W. Phelps. In like new condition, you're going to pay over $600. So that tells you like the kind of premium that people are putting on this. Yet you can go to Audible and get the audiobook for like $20, which also tells you people are really stupid with their money sometimes. Just go to Audible, $20 right there. But it tells you all you need to know about the stock market too, and the smart money. It doesn't really exist, but you can take advantage of it if you're buying and holding, and sometimes even if you're trading. That market pendulum goes from undervalued to overvalued fairly quickly sometimes, and there's multiple pendulums in the market. There's a short term, medium term, and long term, right? But I'm going to paraphrase here. There's a quote here that like kind of brings it all home as to why the opinions really shouldn't matter to you. And think about how bull markets come about. Now think about how the highs in those bull markets where nobody should be buying come about also. Those bull market highs happen when the broad consensus is that stocks are going to continue to easily go higher. And then the outlook and the opinions are more convincing when we're at the very top, when nobody should be doing anything except for selling, right?
Houses never go down in value.
Right. Right.
I've never heard of Goldilocks economy before.
But on that top swing, if you're looking like at a chart of the S&P 500, pick the top of it. That's when the great majority of the people were the most bullish. Otherwise, we wouldn't have been there. So you have to find your own good reasons for buying stocks. Now, on conversely, bear market lows, this is when everybody's screaming sell and run for the hills. And this is when everybody's the most bearish. And when those bearish opinions of analysts are more readily and more easy to find, and when they're the most convincing. So what do you do with that, right? If you're trying to really buy low and sell high, that's the old phrase. You got to really just do your own research. And instead of trying to figure out where you think the market's going to go over the next 6 months to a year, if you're an investor, you just look for opportunities. The numbers won't lie to you. If you think Google, it's a good time to buy Google, you just buy it. Whatever political ideology you have, whatever ideology you have when it comes to investment, if your rules of investing are substituting for your thoughts, you're in a dangerous position. You're going to miss a lot of opportunities. Go ahead, Dave.
Yeah, I just want to say, man, piggyback on what you're saying here, and I know you're getting this from this book, and sooner or later you're going to give us the title of this book. But
it's
what was the
100
title?
to 1 in the stock market.
100 to 1. Okay, 100 to 1 in the stock market. I will throw out this little fact I read today that 270,000 homes in the United States that were purchased this year are now underwater.
Ooh, wow.
270,000 underwater this year because they were purchased this year and the home prices have gone down. I will also say that credit card debt has gone up by 10 billion in the United States this past month. Gone up by 10 billion in credit card debt.
Unbelievable.
A firm's stock price went from $100 a share this past summer down to $10 or $11 a share now. You know, that guys, vehicle loans again up by billions. People taking out loans on vehicles. Inflation means that people are going to be not going to be able to pay all their bills. They're going to make cuts. The market has to adjust eventually. Eventually, people have to stop buying. They're going to run out of credit, and they're going to be like, I can't put any more on my credit card. Just get another credit card. Well, I can't anymore because they raised, the ability. They raised the requirements to get it, and so now all of a sudden, people are going to start actually feeling the hurt. And I don't know how much more the U.S. household can continue to raise how much debt they carry, but they still are continuing to raise the household debt in America month over month, and eventually it's got to break. It's got to break, Brandon.
Yeah, it's wild, and you know what? I'm with you on this. I do think that we're probably going to go into a deeper recession. I don't know that that's the case because I have not been armed with the sixth sense of telling the future. So all I can do is look at stocks and then say whether they're a good deal or not. Now, my prediction of us going to 4,400 in the S&P 500 in December seems like it's completely shot in the head right now. I feel like that's probably completely done for, but I didn't make any investment decisions off that, so I'm fine. I sat there and I started thinking the other day, like, what's the best advice that I can give? And I posted it on Facebook and Twitter too, and I put a decent amount of time. So I'm interested in your opinions as to what I'm about to say, Dave. So, number one, arm yourself with knowledge. Read, soak up as much knowledge as you can about investing. That's number one. It's the most important thing. It's the most important thing that you can do. Number two.
Amen.
Number two, timing the market is rather essential if you're looking to outperform the markets. And it can be done correctly only after you've armed yourself with enough knowledge to be more intelligent than the average investor. However, what you buy is more important than when you buy it.
Okay, so all right, you saved yourself with that last line. You saved yourself,
Yeah.
but you started off by saying time in the markets, and here's where I disagree with you on this. As someone who has lost a lot of money early on in trading, I'm talking about early 2000s where you're an idiot if you didn't make money. But as someone who lost money during that time, that Goldilocks period, I can tell you that if you try to time, it's just it doesn't always work out. It doesn't work out usually, especially for retail traders. Especially for retail traders, it doesn't work out time in the market. Now, if you're looking at I say that by my definition of timing is when you're trying to call an exact bottom or call an exact top. Exactly. That's my definition of how I define timing. So if you're trying to time the market, then you're going to be unsuccessful more than you are successful. And so that's hard to do. Now, what you said at the end there kind of erases everything you said before. And so I like the last comment.
To a certain extent. So you're in this situation. Let's not talk about like trying to find the exact bottom because it's impossible. Now, you said that over those years you were talking about, you had to be really dumb to not make money. Think about the person that bought in like 2009. How stupid did they have to be to not make money if they held on? And this is a weird inverse kind of question because they were probably really intelligent if they were buying in 2009. But how easy buying a good company in 2009 until like 2020?
I mean, you just made tons of money. You just had to buy and hold.
Right, because they did the inverse of what, the CNBC guys and what, the analysts were telling them to do. They did the exact opposite. And I think right now, like, hey, don't try to time the market, but there's a lot of stuff that's out there that's of good value at this point in time, even though some of the stuff has came up 20 to 30% in a month and a half. And even though we're not, near the August or June, June lows or whatever, still right now, like over the course of years and years, missing out on 10% is not going to bug you that much. I know it sounds like 10% that sucks, but if you're looking at a chart and you say, oh, this company's came up 10% over the past year, that's not a reason. That's not a reason to not buy it. A reason to not buy it would be that it's overvalued. If it's not overvalued, you still buy it, right? You still buy a good company. And I think that there's a decent amount out there right now for any 18 or 19-year-old, especially that's got, a very long time horizon. Or hey, even if you're in your 30s like us, you could go out picking stocks and, by the time you're retired, you're going to love the fact that you did it. We're in a bear market right now. Eventually that market's going to swing right back to bullish again. So, but, you have to arm yourself with the knowledge. We talked about the, in the past, I say that a lot, that we've talked about things in the past but we put over like 1,500 hours of content out. We've talked about a lot of stuff in the past, Dave, but, timing the market in the sense that, that we're in a bear market, in a sense that when I was telling you back in December, January of last year that we were in the end stages of a bull market, it was easy for me to tell because, the Federal Reserve was looking at raising rates. Now we're at the tail end kind of raising rates. Probably not the tail end of tightening, of quantitative tightening, but we're at the point right now where I still think that you could start buying into this market. And over the course of 10 to 20 years, you're going to be okay. So arm yourself with enough knowledge to beat the average investor. Your intelligence in the market has to be uncommon. The average investor cannot beat the market averages over time. Think about what I just said. The average investor cannot beat the market averages over time. The math doesn't add up, Dave. If you're the average investor, you're not going to beat the market averages. You're just going to be in line at best.
I will say it took a lot of years for me to be able to do it, and a lot of experience and knowledge. But yes, you're right. The average investor cannot beat the market over time. I will say this: if we're giving out tips to new people, I have a new gentleman that I'm mentoring right now and trying to help with brand new to investing and everything. And some advice I gave to him is he put some money into an account and he was adding more each paycheck. And he came to me almost like every other day. And he's like, hey, you got anything to invest with yet? You got anything to invest with it? You got any? And I had to explain to him. I said, look, you cannot always feel the need to be in something.
Yes, exactly.
You have to be okay just sitting in cash because you have to wait for the right opportunity instead of just putting your money in something now because you feel like you have to be invested in something now. Wait for the right opportunity, then buy it and hold it.
Yes.
You always start by teaching people to buy and hold, because if you can learn that, then you could break off and start doing some day trades. Brandon did the opposite. Brandon started off with options and went crazy for about a year and a half.
Well, really, I started with investing, and then I went in. I've been investing more. I just came back to investing. I wanted to be good at options, and I sucked at it at the very beginning. I was absolutely awful at it, and I wanted to be good at it, just passable. I wanted to be able to beat the indexes, and once I became proficient enough to beat the indexes, I stopped because I didn't want to die 20 years early.
Right? Because like the stress on you from options is crazy. And yes, you ended up beating them. You had 25% return versus a 20% return, but the stress was not worth it, where you could have done the same by just investing.
It was 30 versus 28. I think the S&P was 28%, and I beat it by 2%.
See, right? And the stress wasn't worth it. You could have just put your money in the S&P and forgot about it.
Right. Boom. Right. And there were some days where it was like, oh my gosh, I just had a 200% gain. That was amazing. And there are other days like, I was down 190%. Oh no. I just gave everything back. All right. And you know what? And yeah, you don't always have to be in everything. That's why I didn't buy Google, 2 years ago. I bought it now because I like the value now. Although 2 years ago we were sitting about flat as to where we're at now. But the earnings and versus the price, it just makes more sense to be in Google today than it did then.
So what was the name of this book again?
100 to 1 in the stock market. So this is about increasing your earnings 100 times. This was actually written in the 1970s. So it's 1972. And what he did is he took a bunch of stocks and then figured out the ones that if you would invested at the 1932 lows or near the lows, and then sometimes he even goes up and says, well, if you would have invested in the highs in the 1930s, these are the stocks that would have increased your investment 100-fold. And there's a lot. Man. There's a lot in there. Now,
hopefully Gillette's in there.
I want to tell you, let me just put this out there real quick, because you're gonna listen to this audio book, and in the first couple of chapters, he's gonna mention Xerox and Kodak. So, which we all know what's happened to Kodak in the short term. Kodak, not very good.
I tell you what, man, I guarantee, Brandon, if you go to anybody who's 20 years or younger and ask them what is Xerox, I half wouldn't know.
Yeah, well, if they work at FedEx, they might know.
But... No, you say make a copy now.
Yeah, I know.
Nobody says Xerox. No one says make a Xerox.
I know, and that used to be like the the way to describe.
Xerox lost in court because they tried to sue, saying you can't copyright our name, and everybody was like, no, it's in common use now, and they lost it in court of law. That's how popular it was. But now, if you say it, people don't know what you're talking about.
So what this guy did, though, is he went back, and first of all, he talks about how you do need to sell stocks sometimes, that gold can sometimes turn into pennies, and you just have to keep an eye out for this stuff, and just make sure that your company's earnings aren't topping out, that they're not starting to steadily come down for investment reasons, which an investment reason to him is something like a cancer of some sort in the finances of a company. And what he's saying is that if you're investing for the long term, you never sell for a non-investment reason. And a non-investment reason would be the stock's gone down, or I'm in this stock and its peer has done so much better over the past 2 years. That's a non-investment reason, and it shouldn't enter into your mind, because generally speaking, the value will catch up with it. If it's undervalued, the value will catch up, and you'll be fine over the long term. So you're not selling for a non-investment reason, right? And then a non-investment reason also would be like you made a really bad move and then you bought a bunch of stock in margin and now you have to do a margin call. You have to make sure that that doesn't happen too. Um, so, you know, while we're looking at Xerox and looking at Kodak too, and he mentioned Sears as well, which is another one that's like, okay, in 1972 that was great, and then 2022 not so much. Um, but he went back again to 1932, and out of all the stocks that he pulled, there were quite a few that went bankrupt. But the ones that didn't go bankrupt more than made up for the money that he would have lost in the ones that did.
So you're not always going to have winners that are rocket to the moon, but your averages would be great and you'll make a nice return.
Right. And so what he's saying is that you go and you buy the right companies, and your odds of your being in your favor of being a multimillionaire, if you hold through all of the volatility over years, the odds of you being a multimillionaire in decades even are actually really high.
It's hard to teach diamond hands to people.
Unless they want to invest in a meme stock or something stupid. Yeah, I agree.
And we're talking to a particular person out there who we just loved as Mr. Diamond Hands, and then all of a sudden they turned paper.
Yeah. The one buddy though, like, you know what? We get a buddy that actually really does have diamond hands, and does actually buy the Apple and the Googles and all of that stuff, and holds them no matter what, and he's never going to sell. And he actually texted me today and said, "What do you think about Tesla?" And I said, "Dude, with the way that you do things, do it. Like right now. No reason for you to wait." Because he actually does have those diamond hands, and he does do some things like play around with doji and stuff. But if that's a small percentage of what you're doing, and everything else that you're doing makes more sense, then fine, go to the casino. I don't care if it's like 10% of your money; it's not a big deal. But yeah. So, anyways, that Mr. Diamond Hands, I'll say his name. It's Tristan. He's doing just fine. He's doing good.
We like Tristan. He's been following us since the old Facebook group page days,
And he's not selling this bear market. He's not letting his, emotions or anything like that get. The guy could look at his phone. He has more discipline than most people would if they went into a coma for 20 years.
That's about right. It's about right.
Yeah. All right, so let's see, where was I at? So arming yourself with enough knowledge to beat the average investor. That's where we're at here. And then once you're in a bear market like we are in today, instead of trying to time the bounce back exactly, your energy is best spent continuously looking for opportunity. If you're not willing to do any of these things, or if you don't have the time to arm yourselves with the necessary knowledge to try to outperform the markets, then you can accept that performing in line with the markets is going to be the best that you will do. That's fine. You're going to get on average about 10 to 12% every year. Now you'll have some years where you're going to be 28, 30% like we had on the S&P 500 over the past years. And you're going to have some years like right now we're down 14%. That's going to happen, but it'll average out about 10 to 12% gains over the long haul. That's okay. People that don't have the time to devote themselves to being above average here. I don't have any kids. All right. Dave, you've got a daughter. You still somehow find time to do all this stuff, and I love that. If I had children, I probably wouldn't be able to do this as well as I do. So I completely understand this. Now go ahead.
I just teach her to do it so she can take care of me.
Exactly. Now, if that's the case for you, just pick a low cost index fund, invest quarterly or yearly, whatever time frame you choose. Don't try to time the markets. And maybe you just do this with SPY.
There you go. I like it. All right, so we're getting ready to wrap up here, man. But did you have any other specific stocks or companies that you wanted to mention now to people listening?
So you're asking me like what stocks I want to mention to people, and it's going to be high beta here. Over the course of the next 3 to 6 months, you might, have some turbulent waters. Maybe even over the year, you'll have a turbulent, time. But I'm going to do something that I would not have in my right mind done in January of this year. I'm going to do something. I'm going to recommend what CNBC won't recommend right now. Fang.
Yeah, I mean, everybody's been down on Fang, so that might be a sign that it's a time to get in on Fang.
Yep. I think so. If you're a long-term investor, yeah, absolutely.
Got them diamond hands. There you go, man. Chip away at the mine. I do want to talk about a couple of things, guys. I want to bring some headlines to light here. If you guys aren't checking out headlines and reading into things, got your Reuters subscription or what have you, then you're missing out. Especially if you want to learn how to trade and invest, you need to start reading some articles, start reading some earnings reports. But one thing I want to mention here is there's a U.S. court that's weighing in on crypto ownership and bankruptcy. So all the Celsius and FTX and all those things that are happening right now, the United States court system is looking into who actually owns cryptocurrencies on exchanges. Is it the exchanges themselves or is it the consumers? Who owns that? And it's because of Celsius bankruptcy filing Chapter 11 has brought this all to light and attention. What does this mean to you? If you had cryptocurrency in Celsius, in the terms of service of Celsius, Celsius actually owns that cryptocurrency if you lend it to them so that they can go ahead and give you those higher interest returns on them using it in other means. So you actually don't own that anymore. So you are back of the line when you're trying to recoup your money from Chapter 11. Means you're getting pennies on the dollar.
Robinhood does the same thing.
Yeah,
and if you loan it through Robinhood, you don't own it anymore.
Exact right. And so you got to read your terms and conditions in terms of service, because other companies such as FTX has it in there that you do own the cryptocurrencies. So now when FTX files their Chapter 11 bankruptcy and everything gets washed out of that, the people who actually own the cryptocurrency actually owned it. And they did not loan it, quote unquote, to FTX to give out. So FTX actually broke laws because of that. And so read those terms of service because it's important. And when things like this happen, like, are you going to get just like a penny of each dollar you had, or are you going to get like 60-70% of each dollar you had? It all depends on the terms of service. Read those. It makes a difference. It's in court right now. You can find the article. It's out there. Another article I want to roll out is Bowen has just rolled off its last 747 ever that they're going to make. That was the last one, came off the line. 60 years of production of Bowen's 747 has now come to an end. They will no longer make that plane. They are moving forward with 787s and other plane models, but the 747, they made their last one just this past week, and it is done. So no more 747s. I'm sure that last one will last a good 10 years before it is retired. But the fact that they are not making anymore, and they're moving forward with other ones. The Dreamliners, guys, if you haven't flown on a Boeing Dreamliner, actually is a very smooth ride. I enjoy it. It's a big giant plane. Big giant planes kind of ride that air a little easier than those smaller ones, but when you're flying private, it's you don't have to deal with lines and other people and people starting fights. So there's a give and take. It's a little bit more bumpy, but I don't got to deal with Joe down the street there.
Yeah. Well, 787, so. I agreed. I actually had a very good time flying on that. But
yeah, they're smooth.
End of an era.
Yeah, 60 years of production done. Crazy. All right, Brandon, final thoughts.
Fang. and I only own a couple of them, so I'm not trying to pump them all. But
gotcha.
And that's Facebook and Google. Well, Meta platforms and Google. But yeah, that's just you have to think the next step ahead. It just like you're playing chess. What's the next step? Where are we going from here? And it's not where have we been. We know where we've been. It's been a bad year for the NASDAQ. It's been a bad year for Fang. Where are we going?
There you go. I like it. I'm going to put this out here again. I put it out last year, guys. I'll do it again this year. If you tell all your friends and you follow us on Instagram and you tell everybody you know, and we get over 1,000 followers on Instagram, I will go ahead and we will randomly pick someone to win a pair of Ray-Ban Wayfarer smart glasses. Smart glasses where you take videos and pictures and record and everything with your glasses, and it Bluetooths to your phone. Pretty cool gift, pretty cool thing to have. But we got to hit 1,000 Instagram followers by New Year's Day, New Year's Eve at midnight. And then I will give one away to one of our followers. So
I'm a follower, Dave. Can it be me?
It could be you. Since it can't be me, since I'm the one and it's my account. I guess it could be you technically, but we're not going to give it to you. So tell your friends and family, guys, follow us on Instagram. We enjoy it. I'll try to post more from now until the end of the month. But please, let's get up to 1,000 followers on there. That way we could grow even faster and help more people, because that's always our goal. All right, guys, as always, we hope we've been entertaining, educational, and uplifting, because we want everyone to make money.
Who else does this for free? Nobody else.
Nobody else does it for free, man. Everybody else is like, if you want more information, if you want us to really help you, sign up for our mentorship program. Starts off at $3,000. I'm not joking. Everybody laughs at that. I've had buddies who have actually spent $3,000 to sign up for stock companies that send out those stock alerts, buy this, buy that via email. And they said they've made money, right? So we Brandon and I, last year, we did a test. We asked my friend Mark, hey, Mark, you've done these things before. We'll send you text messages to see if we can help you out, just like these other companies would have. And we did, and Mark made money. He made money with our trades, right? And so we can do it, and we can do it for free. But you guys just got to DM us, message us, ask us. We try to give general vague advice on here, and sometimes we make calls, sometimes we don't, because we're just trying to help the general public as a whole. We're trying to lift everybody up, and so it's not always very specific by XYO company at this price. It's not always that way. Sometimes it is, sometimes it's not.
Teach a man to fish, or woman to fish. Or fish for them, whatever. I would rather teach them to fish. That's it. And I don't, when I'm talking on this podcast,
Thank you.
We don't always know, what your risk tolerance is. So I'd rather teach you how to do things and let you do them yourself.
Thank you for butchering a very good saying. That's why I called you George Bush there, man. I was like, what's up, man? He's butchering a saying here. All right. Anyways, on that note, have a good night, guys.
Have a good night.